In a normal economy, there is a simple, undeniable equation. When the supply of a product goes up, the price comes down, and buyers rush in to scoop up the deals. This chart shows exactly what that looks like in theory. You expect the price line to drop and the demand curve to shoot upward. Right now, in the new home market, the first half of that equation is happening. The median price for a newly built home has dropped to $400,500, a 6.8% decrease from just a year ago. Look at what is happening to the supply side on this same chart. Builders are sitting on an estimated 476,000 available units. That pushes the total supply of new homes to a 9.7-month stockpile. Decades of economic history tell us that plunging prices and near-record inventory levels create a textbook buyer's market. It is the exact environment that usually triggers a frenzy of record-high sales. But the U.S. Census Bureau data from January 2026 paints the completely different picture of the consumer. This graph tracks the annualized pace of new home sales over time. Instead of the massive surge you would expect from all that available inventory, sales plummeted down to an annual clip of 587,000 units in January. That is the slowest movement the market has seen since October 2022. Forecasters expected a pace of 722,000 units. Even the previous January easily hit 662,000. The housing market is offering the cheapest, most widely available new construction we have seen in years, yet it is suffering a multi-year low in actual transactions. Buyers are walking away from the exact conditions they usually beg for. To figure out why the numbers do not add up on paper, we have to look at the physical reality on the job site. The retail price of a finished house is falling, but the cost to actually build that house is going in the opposite direction. The National Association of Home Builders, or NAHB, is a trade association that monitors the residential construction industry. They track how optimistic developers are feeling through a metric called the Housing Market Index. This gauge visualizes the current builder confidence score, locked at 38 out of 100. It has been stuck in this negative, pessimistic territory for nearly 2 years. Builders are anxious because they are caught in a math problem they cannot solve. They have to lower retail prices to attract hesitant buyers, but their own baseline costs for raw materials keep climbing. This breakdown chart isolates the wholesale inflation data from February. It shows a 3% year-over-year increase in residential construction goods. A massive chunk of that spike comes directly from the surging cost of metal products. On top of the expensive metal, developers are fighting for a shrinking pool of buildable lots and dealing with widespread labor shortages across the construction trades. Builders are squeezed in a vice. The broader economy demands they sell houses for less, while the daily reality of the construction site forces them to spend more just to get a foundation poured. For the last decade, developers relied on a reliable defense mechanism to protect their profit margins from inflation. When materials got more expensive, they simply built smaller houses. This blueprint animation shows the median home size peaking at nearly 2,500 square feet back in 2015. After that, the walls start closing in. The decline steepened heavily through 2022 and 2023, as higher mortgage rates and material costs forced everyone to accept less space. But look at Q4 2025 census data. The shrinking stops. The median square footage has completely flatlined at exactly 2,183 square feet. Builders have hit a physical wall. They cannot squeeze the floor plans any tighter without losing the single-family homebuyer entirely. Their best tactic for absorbing inflation is officially tapped out. Meanwhile, buyers have their own hurdles. Intense winter storms battered the country early in the year, physically keeping people away from open houses and depressing foot traffic. Builders have zero room left to absorb rising costs, and consumers are maxed out by housing affordability constraints. The result is a psychologically spooked buyer base that has retreated from the market. We are left looking at a macroeconomic landscape frozen in place. Supply and demand are not balancing. They are locked in a tense psychological standoff. Nearly 10 months' worth of newly built homes are sitting idle on the market, waiting for buyers who refuse to show up. Behind those empty driveways are the invisible headwinds battering the construction industry: expensive metal, scarce lots, and missing labor. Calling this a buyer's market looks good on paper, but statistical price drops do not matter to consumers if the monthly payment is still out of reach and the homes cannot get any smaller. Simply dropping the sticker price by a few percentage points is not enough to thaw out the real estate market in 2026. Until the underlying cost to build a house comes down and consumer anxieties clear up, those pristine new developments will stay awfully quiet.